Well, they say that a week can be a lifetime in politics. It feels like that now on the investment markets. May was an extraordinary month. After things seem to have been calming down in March and April, it went crazy in May. We'll be talking to David Bacher about the Corion report. David, of course, compiles this, well, within a couple of days, as we now know, of the end of the month, and he is with Corion. You remember that movie Jaws? And many years ago, it was very famous, and it said, just when you thought it was safe to go back into the water. Well, on the last couple of months, David, you've been saying, thank heavens, things are stabilizing, things are calming down. Jeepers, but the people in May didn't hear that.
Absolutely, Alec. It was a very challenging month for investors, and it was one of those months that it was actually quite easy to look either like a genius or a fool by getting really one decision right, and that was how much of your assets you had offshore. Otherwise, you really, really struggled, and this was obviously due to the weakness of our rand, which was, in the opinion of Corion, the standout event of the month. And that affected all South African assets, particularly the interest rate sensitive shares and our government bonds.
Yeah, it was quite extraordinary. As we have been doing recently, I'm quite keen for us to go across to the presentation itself. So let's have a look at that number and just pick up. That's a nice introductory slide. Look at that one, David. The rand over 10 years. I pulled this from Bloomberg, our partners at Bloomberg, and you can see as bad as Nenegate was, as bad as COVID was, we had it even worse in May, and now we're at an all-time low for the rand, very close to 20 against the US dollar.
Agreed. I found this a very interesting graph, and it's one of the graphs we look at our investment team, and one of the key long-term indicators of the currency is purchasing power parity. And the trick with purchasing power parity is knowing when your starting point is. So if you take your starting point, let's say at Nenegate or even COVID, and you adjust for inflation differentials between our country and overseas country, you should get a long-term trend in where the currency goes to. Now, if you take Nenegate, a period of significant crisis for South Africa and COVID, and you use the inflation differentials, you actually get to a very similar position to where we are now. So you're taking what was then very extreme events and comparing it to today, inflation adjusted. And you got to ask yourself as an investor, yes, we are going through a tough time. Is it worse than Nenegate? Is it worse than COVID? So we've been there before, but you are comparing extremes to an extreme period now, and you get to similar levels.
Are we in an extreme period now then? Because to me, I remember Nenegate terribly well. I remember the absolute panic around COVID, and those were outliers, or so they felt at the time. Now we've got a lot of problems going on. South Africa is really shooting itself in both feet over the Russian support in the Ukraine war story, but it almost doesn't feel quite as extreme as Nenegate or COVID, but I guess the markets are saying it is.
Well, that's certainly our view. Unfortunately, in investing, you take a longer term view, and over the short term, you could look a little bit foolish. But our view is we have problems. I don't need to recite what those are. It's well known. But is it worse than Nenegate and COVID? And are we being adjusted and compensated for those levels of risks with our assets and our level of returns that you get from our bonds? And it could get a bit worse from here, but we think, we bounced back from these levels before. History doesn't often repeat, but it sometimes rhymes. And at some stage, risk avoidance becomes return avoidance. And hopefully we're close to that stage.
David, are you looking then, from what you've said, to investing in the South African market, almost like taking advantage of the extremes? We're going to go through May's numbers, and my goodness, we're at extremes now, any way you want to look at it. Would that be a trigger for you to invest more aggressively or have a heavier weighting towards the JSE?
I think so. Look, we have been admittedly maybe a little bit overweight offshore assets, but at Corion we never go all in or all out. So we've had quite a balanced approach. But you've got to take almost like a 2 to 3 year term view. And yes, shares are reporting difficult earnings per shares as a result of a depressed consumer, load shedding, etc. But in 2 to 3 years' time, what are you paying for these shares in terms of the dividend yield you're getting and the future price to earnings ratios? And I think you're going to be looking back at this time and say there was a lot of opportunities. Can you believe you could have bought XYZ share at a dividend yield of 8%? So I think if you have good stock selection, you buy those shares that you think can stand strong during tough times and see its way through. I think there will be this will be a time to reflect that there was a lot of opportunities to invest in certain shares.
Well, here are the asset returns of the past month, 3 months, 1 year, 3 years, 5 years. And you can see this is from the Corion report. The worst performer last month was the Rand against the US dollar, down 8.5%. But for the year to date, it's dropped by more than 15%. So it was a terrible month, but it is just, as we saw from the previous graph, a continuation of a very depressing trend. South Africa's share price falling sharply.
Correct. And that's how I started this interview. That was the defining event in the month. The Lady R and the politics came a little bit from the left field for a lot of people. And that was the driver of our returns and how investors are going to look at their statements with either a smile or a bit of a strenuous face come their valuation statements.
So it's very clear in the 1 month category there, the point that you made. Global equities 7.5% higher, and this is an average, and South African equities down 4%. So it's a double-digit swing, depending on where you were.
Correct, and it's actually probably worse than it appears in this graph. So you have South African equities down 3.9%. That's using the FTSE All-Share Index, which is an index that's quite heavily weighted to gold shares and Richmond. If you take a more broader index, let's say an equally weighted index or a CapSwix index where most asset managers actually use that as a benchmark, you're down closer to 7%. So even that divergence is probably understating how important your allocation between offshore and local assets were.
3 months, 1 year, global equities really outperforming South African equities. And yet, they're on the 3-year basis. It shows that South African shares don't fall forever. They do have a rebound because, in fact, over 3 years, they've done better than global equities, despite this craziness on the Rand.
Correct. And that's why we always say take a longer term view. We were looking like rock stars at Corion a month ago, 2 months ago, because we were overweight SA equities. And, investing is for the longer term. These things, you can't call the turning points exactly. You've got to follow a investment strategy that you believe in. And at Corion, it's a valuation-based investment approach. So, don't get too focused on the 1 month. Know what's happening. Look at the 1 month, 3 month, but always have the longer term in sight. Focus on where the puck is going, not where the puck is.
When we consider the South African market itself, in the past month, everything was down. But if you take 3 months or indeed over a year, if you'd been in the right stocks, you could still be doing okay.
Correct, but it's still quite a narrow market. If you look at the 1 year returns, you're referring to industrials up 34%. Our biggest shares there is, as I said, Richmond and Naspers. That was the driver of those returns. The rest of the market, looking a bit broader, we're nowhere close to that at 34%. So very much the same theme of offshore assets was the place to be.
And resources, after having a fairly good time in the recent history, are coming under a bit of pressure now.
Correct. It's once again when your starting point is, gold shares within the resources basket has done exceptionally well, but you've had copper, platinum really, and commodity prices being under pressure. in this global environment.
The thing that would surprise most people is that we are in a higher interest rate environment, which is usually very good for financial stocks, particularly the banks. They tend to have this endowment effect. In other words, their masses of shareholder funds gives them, they earn better interest rates on it. They have a wider spread between what they pay people for the money that they lend, that they borrow. In other words, our savings, and what they get in through their lendings. And yet, financials, having a look at the Corion report, if you go back, they've been very poor performers all the way back to 5 years. It's only property that's been worse. How do you uh, kind of work the logic here?
Okay, so let's break up financials into probably two key elements. You've got your banks and you've got your insurers. So, there's an element of, especially particularly in insurance, our bond yields have kicked up dramatically. That means the discount rates at which shares are valued is kicked up, is increases. So if you discounting future cash flows to today's values, your value of your future earnings is less. So I think that's particularly impacting the insurers and to some extent the banks. And I think the other element is, or another two elements is, particularly at the banks, when you're going into more of a depressed environment, the consumer's more under pressure, the potential for increased provisions of bad debts increases. So that's what I think investors are grappling with. And then the third element is, once offshore investors want to sell, they sell the more liquid stocks. And what are more liquid stocks in South Africa? A lot of the banking shares, a lot of the insurance. And I think, when the tide goes out, unfortunately, the financials went out with it.
Indeed, they did. And it's been a particularly difficult time for, I'm sure, Koki Koiman, who's been talking up banks for a while. We've been going along with him. And I know in the BizNews portfolio, one of our biggest stocks is First Rand. And we also have ABSA in there as well, and they have not been doing terribly well. When you dig down and you in the Corion report, this is part of what I really like, is that you take all of the unit trusts and then you show who've been the best performers for the month, for the year. And for the month, the best, only two of the general equity unit trusts in South Africa, or South African general equity unit trusts, were positive, and they were tiny. On the other hand, on the global equity side, it's been gangbusters, where most of the unit trusts there were positive, and many of them in double digits, which gets back to what you were saying a little bit earlier, that this was a month that if you had your money offshore, you looked really clever. If you had it based in South African shares, not so good.
100%. I think the graph that you're showing now, the table that's showing the global equity, when I reviewed this, I thought this was one of the standout points for me. And I want to touch on what I thought was the second defining point of the month, is how divergent even offshore returns were for the month. So if you look at the two Signia funds here, Signia FANG plus equity fund, 1 year return, the best performing fund in the industry, 66%. So you're immediately thinking tech has really shot the lights out. But if you look at the worst performing shares, the fourth worst performing is the Signia Fourth Industrial Revolution Global Equity Fund at 15%. That's a massive divergence in funds that are on similar high risk kind of valuations. And that shows you how offshore markets, particularly the NASDAQ, has been driven by really 7 shares, which has contributed, the big fangs, or I think they call it the Marvelous 7 now, have really shot lights out. It's been a mega cap technology run offshore. Other than that, the offshore markets hasn't really done as well as it might appear. It's been driven by those large mega cap shares.
Very good point. And if you had missed out on them, if you hadn't bought Facebook, well, I suppose it's not Facebook anymore, it's Mega now, Amazon, Apple, Netflix, Google, etc. If you weren't invested in those, as the point that you've just made, and you were more widely spread into tech shares, you actually would not have performed that well. But if you were invested in South African general equity funds, you would have underperformed almost certainly the offshore in the past year.
Correct. I saw an amazing stat that the top 7 NASDAQ is 100 components, were up about 3.4 trillion this year in terms of market cap value. while the bottom 93 was barely up. So all your returns was coming from Alphabet, Apple, Microsoft, Amazon, Meta, Tesla, and Nvidia. Those were the 7 shares that actually drove your performance.
Extreme times. And as a result of that, the inflow into the industry also looks quite interesting. I like picking up on this because it does also show that there's a movement, and you look at this in the Corion report. There's definitely a movement of money towards the better performers over the longer term, and quite a few of the boutiques are doing pretty well, David.
Correct. A very healthy sign for the industry. Our industry has been dominated by 3 or 4 houses over the last 10 years, or maybe a little bit longer than that. I don't think that's healthy. I don't think those asset managers managing such large scale of assets in the South African environment is a good thing. It doesn't really lead to great price discovery in the market and to competition. And I think this is a good development for the end consumer.
And then the outflows, you're seeing again dominated there, the outflows by the big stocks, the big houses, Allan Gray, Coronation, Stanlib, 91, or Sanlam even, very much in the biggest of the outflows of the past month. And they appear as well on the tables for the past year.
Correct. I think that's more of a function of, how big those asset management houses are. You got quite a lot of outflows happen in the industry, particularly when times are tougher. So take Allan Gray, for example. They've had an unbelievable 1-year period in terms of the larger houses. They're probably the best performer, and they're still having outflows. So you've got to also take that into account, A, the size of the manager, and B, the environment that we're in.
So what's keeping you, I ask you this every month, what's keeping you as a money manager awake at night?
I think we're looking at really the bond yields, and that's really your pricing of South African risk. If, over last month, our long 10-year bond yields have gone up about 90 basis points. That's a big development. If you start having our bond yields start decreasing, I think that's a sign of a healthier environment where foreigners will come back. At the moment, if you're buying a South African 10-year, you're getting a real return of 5.5%. That's historically a very, very attractive a rate. So, but that doesn't bode well for how offshore investors and how you value shares, because your interest rates are high, your discount rates are high, valuations tend to be lower.
Everything is related. It's a pity sometimes that you couldn't get those who are making these things so difficult for investments. If you couldn't put them all into a room and say, here, this is how it works, guys. You screw up on the political side, you shoot our country in the foot, as you've been doing, you will get punished by paying higher interest rates on the government debt. You'll pay higher interest rates on the money you have to borrow every year to keep this country running, which means that you'll have less money available to pay for the social wage, and the poorer people, will not be able to get into a better situation. It's just all related. So you make a dumb move like the Lady R giving arms to Russia, and the consequence of that is horrific. I've heard some terrible stories about investments that were coming, big investments coming to South Africa that have been pulled because the Western world says they don't feel welcome in a country that welcomes Putin with open arms. And I don't know if those messages are actually landing in Pretoria where they should be.
Agreed. It certainly doesn't appear so, and I think we all resonate with those concerns. But I probably want to end with maybe a positive story, because in times like this, it's nice to focus on something positive, because everyone knows about the negatives. So if you look at the returns of South African as investors, if you look at the high equity, that's where the category, that is where majority of pension fund assets are. A decade ago, you could only have 15% of your assets offshore. Now, because of our government and because of a CISA and because of what they've been doing, that limit has increased steadily to now 45%. So the opening up of our retirement funds has resulted in most pension fund assets being exposed to between 30 and 40% to offshore assets. And as a result, despite the economic troubles and the share price performances in the local market, at least investors, long-term savings and pension funds actually had the opportunity to diversify and didn't feel as much as a brunt as you would have expected. So let's at least acknowledge that.
Well, we can celebrate one thing about the new South Africa. We've become part of the world, and we've been allowed to go into, our money at least has been allowed to go into the 99.5% of the world economy that is outside of our borders. You just think about the old South Africa with exchange controls being very tight. That would have been a very, very different story. So thanks for giving us that upbeat ending. David Bacher from Corion Capital. I'm Alec Hogg from BizNews.com.